Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
It's good to be here.
Today, we're breaking down a true industrial and creative leviathan, one of the most requested and, frankly, most complex companies out there, Sony Group.
A leviathan is the right word. It's a global ecosystem.
Exactly. And on the surface, you see this incredible library of content, PlayStation, Spider-Man, you name it. But the real question for us as long-term investors is this. Has Sony finally built an economic fortress strong enough to shed its old reputation as a volatile electronics maker and overcome that infamous conglomerate discount for good?
That is a massive question. And before we get into the details, just a quick note for everyone watching.
Right.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel.
And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model and that competitive fortress.
Let's do it. So, Sony, this isn't just one company, right? It's a collection of massive businesses stapled together.
It really is. I mean, you're trying to analyze 6 distinct, multi-billion-dollar global enterprises all at once. You've got video games, you have film, music, consumer electronics, specialized semiconductors.
And a huge insurance business in Japan.
And a massive financial services arm. It's a lot. And that's the core challenge, really. How do you pull a clean, coherent investment thesis out of all that complexity?
Because the market hates complexity.
Hates it. Which leads right back to your central question. Where does the real durable value actually lie, and how can we be sure it's protected? That's the mission today.
So is this big structural shift they've made, moving away from just selling boxes and electronics towards owning IP, is that moat finally strong enough?
That's what we have to find out. Is it durable enough to finally shake off that historical valuation drag, that conglomerate discount?
And what's the thread that ties all of this together? From a PlayStation 5 to a tiny image sensor in a phone, I know they have this internal guiding principle.
They do. It's Kando.
Kando.
It's a beautiful, simple Japanese term. It basically means the power to generate an emotional experience that touches the heart. That's what connects all the dots.
Okay, so let's unpack that for a second. It's not about selling an aluminum box. It's not about a piece of glass. It's about selling a feeling.
Exactly. The thrill of playing God of War, the nostalgia of a classic song from their music catalog, the clarity of a photo from one of their sensors. Sony is fundamentally in the business of monetizing human emotion.
And that's so critical for understanding their shift towards recurring revenue, isn't it?
It's everything. Because if that IP-driven high-margin revenue stream is now strong enough, it could finally decouple their valuation from the old ups and downs of selling physical hardware.
All right, so let's start with that foundation, the moat, the structural advantages that protect this whole thing. You've got 6 segments. They seem all over the place, but there's a logic to it.
There is. You can really categorize them into 2 main buckets, platform and hardware on one side and content and IP on the other.
Okay, what's in platform and hardware?
That's your delivery mechanism. So you have game and network services, or G&S. That's the PlayStation console and the whole online network. Then there's ET&S, which is your consumer electronics, TVs, the alpha cameras, headphones.
And the really important one that people miss.
And the critical B2B powerhouse, imaging and sensing solutions, INSS. They make the image sensors.
And on the other side, the sticky high-margin stuff.
That's your content and IP. You have music publishing and recorded music, one of the biggest libraries in the world. You have pictures, which is film and TV, and now the anime giant Crunchyroll. And then the outlier, financial services.
The insurance business in Japan, which we'll definitely circle back to later with the spinoff.
Exactly.
Now, you've mentioned this big global trend, dematerialization. How does that play into Sony's advantage here?
It's a massive tailwind for them. I mean, dematerialization is just this big shift where value moves from physical things to digital experiences.
Like from buying a CD to streaming on Spotify.
Precisely. And that's perfectly aligned with where Sony is going. Their future isn't about selling more TVs. It's about selling more PlayStation Plus subscriptions, getting more streaming royalties from music, licensing content digitally. It gives them a consistency their old hardware business never, ever had.
Which brings us right to the moat itself. You argue it's not physical at all, it's intangible?
100%. The foundation of Sony's fortress is its intellectual property, its cultural library. And this stuff it's just not replicable.
What do you mean by not replicable? A competitor with deep pockets couldn't just buy it up.
No, absolutely not. You can't just go out and buy cultural relevance. We're talking about the world's most valuable music catalogs, Michael Jackson, the Beatles. You have film IP like Spider-Man, and then you have gaming franchises that define generations. The Last of Us, God of War.
So it's not just assets on a balance sheet, it's cultural history.
It's embedded cultural history. Their music publishing arm is basically a perpetual royalty stream on songs that are foundational to pop culture. It's an annuity financed by history. No amount of R&D spending can create that overnight.
And this ties right into the engine room, gaming, where the lock-in is just incredibly powerful. The switching costs are huge.
The switching costs in GNNS are their frontline defense, especially against Microsoft and Xbox. I mean, a dedicated PlayStation user isn't just someone who bought a console. They are an investor in that ecosystem.
They've spent hundreds, maybe thousands of dollars.
Exactly. Over years, building a digital library, often with over 100 games.
So what's the actual cost to switch?
It's multi-layered. Financially, you're abandoning that entire library. All those $60, $70 games are just gone. But psychologically, it's maybe even more powerful.
The social graph.
The social graph, your friends list, your online identity, the continuity within the PlayStation Network, that creates this massive inertia. The barrier to switching is just extraordinarily high, which is why that PS Plus subscription revenue is so sticky.
And this all leads to what you call the mode in action, this synergy, the Lollapalooza effect.
Right, the Lollapalooza effect is where all these individual parts combine to create something that's just bigger and structurally unique to Sony. And the perfect textbook example is The Last of Us.
The HBO show,
Oh.
a massive cultural moment.
A huge moment, and the show was made by their picture segment. So what happens across the rest of the business?
The game sales must have exploded.
Exploded immediately. You saw a huge spike in sales, in re-engagement, in playtime for a game that was years old. And at the same time, the music from the game, the score, saw its streams in the music segment go through the roof.
So one piece of content, which they own entirely, is generating new, high-margin revenue across 3 different divisions at the same time.
Simultaneously.
Hmm.
And here's the kicker for investors. The cost of content acquisition for those extra game sales and music streams was zero. They already owned the asset.
And competitors just can't match that.
It's very difficult. Disney has Marvel, but they don't own the gaming platform. Microsoft can buy a studio, but they don't have the integrated film and music infrastructure. Sony owns the entire value chain.
And that advantage lets them have real pricing power, which is the ultimate proof of a moat. We've seen it with the PS5.
We absolutely have. Price inelasticity is the clearest sign you have a strong moat. Sony raised the price on the PS5 console itself. They raised the price of their big first-party games from $60 to $70.
And they've raised the subscription prices for PS Plus.
And they did it all without seeing significant churn. If the moat was weak, people would have just jumped to the next best alternative.
But they didn't.
They didn't. They stayed. Which confirms that their customers see the value in the ecosystem, the brand, the exclusive IP. They're willing to pay a premium for it. That is pure pricing power in action.
Okay, so if the IP and the gaming ecosystem are the crown jewels that everyone can see, let's talk about the secret weapon, the hidden B2B segment, INSS.
Right. Imaging and sensing solutions. On the surface, it feels like the opposite of Kando. It's just selling components.
But you argue it's maybe their most critical advantage.
It is arguably their most critical structural advantage. This is where their technological sovereignty meets incredible scale. Sony isn't just a player in CMOS image sensors. They are the undisputed global market share leader.
They make the eyes for almost everything.
For everything that needs to see clearly. Premium smartphones, cinema cameras, drones, and most importantly for the future, autonomous vehicles.
This is a segment that I think a lot of investors just gloss over because it's B2B, it's technical. But this is where that mental model of scale economy shared really comes into play.
This is the absolute crux of their technological Tollbridge. Sony invests billions year after year in R&D and CapEx just to stay ahead in sensor quality.
These massive fixed costs.
Huge fixed costs. But because they are the supplier to basically every major premium smartphone maker in the world, they can spread those R&D costs across the highest possible volume of high-end units.
So the cost per sensor gets driven way down.
Precisely. which allows them to be both the highest quality producer and the lowest cost producer at that specific quality level. That's the scale economy shared model. They share the benefit of their scale with their customers.
And in doing so, they make it completely irrational for a competitor, even someone like Apple, to try and build their own.
It's economically irrational. The time, the capital, the R&D budget required to even attempt to catch up is prohibitive. So they've engineered a situation where their biggest rivals are forced to pay them.
A technological royalty.
A technological royalty on every high-end photograph taken on the planet. It's a fantastic business model, and the barriers to entry are just immense.
Let's zoom out to the broader competitive landscape then. In gaming, it's a fierce rivalry, especially against Microsoft. How are they positioned differently?
The differentiation is incredibly sharp. Microsoft has gone all in on the value strategy with Game Pass. They put their biggest games on there on day one. It's a loss leader to drive subscriptions.
Sony refuses to do that.
They refuse. They protect the margins and the scarcity value of their premier content. They treat a new game like a blockbuster movie release, not just another piece of content in a bundle. It's a fundamental difference in philosophy. Margin discipline over just chasing volume.
And what about Nintendo? They seem to be in their own world.
It's spatial separation. Nintendo completely dominates the family-friendly, unique IP space. Mario, Zelda, their consoles are about unique mechanics, not raw power. Sony dominates the high-fidelity, cinematic, AAA experience for an older demographic. They really aren't competing for the same dollar.
And in the sensor business, INSS, they're up against giants like Samsung. How do they win there?
It's the same story, quality over volume. Samsung will compete on sheer breadth, supplying a huge range of devices. Sony focuses on maintaining that technological lead and winning the high-end, margin-rich contracts. They want to be in the flagship phones and the most advanced automotive systems.
That discipline seems to extend to their M&A strategy as well. They're not just buying things to get bigger. They're very strategic.
Incredibly strategic. Look at the acquisitions of Bungie and Crunchyroll. They are perfect case studies.
What did Bungie give them?
Bungie, the studio behind Destiny, gave them instant world-class expertise in live service games. These are games designed to keep players engaged and spending money for years. It was a direct strategic move to reinforce their ecosystem against the threat of Game Pass.
And Crunchyroll.
Crunchyroll effectively bought them dominance in anime, which is a massive secular growth market. It gives them a dominant position in licensing, production, and distribution. It's not just expansion, it's vertical integration to own key parts of the content value chain.
So a great business model is one thing, but it can be ruined by bad management, and Sony has had its share of that in the past. The last decade, though, has been a story of real transformation.
A profound transformation, yeah. Primarily under Kenichiro Yoshida and now Hiroki Totoki. They've pivoted Sony from this sprawling, unfocused electronics company into a creative entertainment company.
And Yoshida's whole philosophy was that technology is the tool, not the purpose.
That's the critical distinction. The purpose is the content, the Kando, the PlayStation, the camera. Those are just the high-quality delivery mechanisms.
But that pivot couldn't have been easy internally. They had this famously siloed culture.
It was incredibly tough. For decades, the PlayStation division wouldn't talk to the TV division. The engineers in one part of the company had no idea what the studio heads in Hollywood are doing.
The whole One Sony initiative was meant to fix that.
It has improved things, but that tension is still there. You still have this pride among the engineers in their technological sovereignty, which sometimes clashes with the fast-moving creative side of the business. It's this ongoing pull between the engineering mindset in Tokyo and the creative mindset in LA.
But what matters for investors is capital allocation, and there the track record has been much more rational.
Fundamentally rational and disciplined, and the first proof of that was the really hard choice they made a decade ago.
A dividend cut.
Cutting the dividend, which is almost a sacred act in Japanese corporate culture. But they did it to stabilize the company. It showed a willingness to prioritize long-term health over short-term appeasement.
And the most current sign of that rational thinking is the planned spin-off of the financial services group.
This is the ultimate rational move. SFGI is a massive, successful insurance and banking business. But inside a public conglomerate, it's a huge drag on the valuation.
Why is that?
Because financial services are capital intensive, they're highly regulated, and they trade at a much lower earnings multiple than high-growth entertainment or tech assets. So keeping it under the main Sony ticker just penalizes the value of everything else.
So by spinning it off, they simplify the story.
They simplify the entire organization. And that allows the market to value the remaining entertainment core, the IP, the games, the sensors, on a much cleaner, higher multiple. Plus, the spin-off itself will generate a massive amount of capital.
And what would they likely do with that cash?
The clear expectation is substantial share buybacks, which reduces the share count, boosts earnings per share, and signals that management thinks the remaining business is undervalued. It's the biggest catalyst they have for finally getting rid of that conglomerate discount.
Let's talk about the numbers that back this up.
Yeah.
The financial resilience. It's not the old Sony where one bad product could sink a year.
Not at all. The financials have stabilized remarkably. The combination of the music and game services provides this consistent high-margin floor for earnings. The volatility from hardware cycles is just so much more muted now.
And how does a key metric like return on invested capital look?
The ROIC is solid. It sits in that 9 to 10% range, which for a company with capital-intensive divisions like sensor fabs and console manufacturing is very robust. And critically, it's trending upwards as the business mix shifts more towards asset-light IP.
And finally, the balance sheet. This is where their discipline really shows.
The balance sheet is pristine. They operate with very, very low leverage. If you look at net debt to EBITDA, it's usually between, a negligible 0.2 and 0.5x.
That's incredibly low for a company this size. What does that give them?
It gives them a massive financial buffer. They are prepared for almost any cyclical downturn, and it gives them the dry powder for strategic, opportunistic acquisitions if a major piece of IP comes up for sale, all without having to raise debt. It is a fortress balance sheet.
Okay, so you have this high-quality business, irreplaceable IP, a hidden monopoly, rational management, and yet Sony has historically traded at a discount. Let's tackle that valuation paradox.
It's purely the conglomerate discount. The market just struggles to value a bank, a film studio, a chipmaker, and a gaming company all under one ticker. It's too complex for a simple peer comparison, so the multiple gets depressed, usually in that lower 14 to 18 times PE range.
Which is way below pure-play entertainment companies.
Significantly below. Companies like Universal Music Group can trade at multiples in the high 20s or even 30s. If Sony was valued just as an entertainment business, its multiple would likely be much, much higher.
So as an investor, how do you define a margin of safety here? When do you know you're getting a good price?
The margin of safety exists when the valuation implies the market is only valuing the obvious parts, the consumer electronics, the console hardware, and is basically giving you the hidden high-growth assets for free.
Is there a number on that?
Historically, an enterprise value to EBITDA ratio below 9 times has been that strong safety buffer. At that level, you're essentially getting the entire generational IP library and the explosive growth of the sensor business for free, just because the market is too confused to price it correctly.
The classic confusion discount. So where is the primary growth engine going to be for the next 5 years? It has to be INSS.
Absolutely. The imaging and sensing solution segment is a secular growth machine. The world is moving towards autonomous vehicles, industrial IoT, advanced robotics, and all of these things need incredibly precise, reliable eyes. And that's what Sony makes.
So the auto sector is the next big wave for them.
It's the next massive wave. The safety requirements for autonomous driving demand the best-in-class sensor technology, and Sony is the leader there. They are perfectly positioned to collect that technological royalty from the trillion-dollar auto industry.
But a business that relies on global manufacturing also has significant geopolitical risks.
And that is their primary vulnerability. Their supply chains for the PS5, for the sensors, for cameras, they're exposed to any friction, particularly in Asia. Any serious disruption, any trade tariff, any tension around the Taiwan Strait directly impacts their ability to manufacture their most profitable products.
Okay, let's get to the permanent impairment risks, the things that could really kill this whole thesis.
The biggest existential threat is in gaming, and it's the disruption from ubiquitous, low-latency cloud gaming.
Because Sony's whole model is based on controlling the platform, the console.
The console is the physical toll booth. If streaming quality gets so good that it's instant and reliable everywhere, the need for a proprietary, expensive box in your home it becomes obsolete.
And if that happens?
The platform control evaporates. The digital library lock-in, the subscription toll booth, it all crumbles. The control point shifts to the big data centers owned by Microsoft, Amazon, or Google. That would destroy a massive amount of Sony's enterprise value.
The other big risk is more human, the hit-driven risk.
Right. Their reputation is built on the incredible quality of their first-party games. They're known for these cinematic blockbusters. If PlayStation Studios were to have a creative dry spell, produce a few flops in a row, The brand loyalty, the halo effect, it could diminish very quickly.
But despite those risks, you see major catalysts on the horizon. We have to come back to the financial services spinoff.
It's the single most important capital event coming up, slated for 2025 or 2026. It's a surgical separation designed to unlock value. It simplifies the whole story for the market.
So after the spinoff, the pitch is just cleaner. Global IP owner, leading game platform, B2B sensor monopoly.
Exactly. And that simplification should lead to a dramatic re-rating of the remaining business to a higher multiple. And of course, it provides the capital for those huge share buybacks we talked about.
And the other catalyst is mobile gaming.
This is critical for growth outside of the console base, especially in Asia. Taking their premier IP, imagine a mobile version of God of War and putting it in front of billions of mobile users instead of just the 100 million plus console owners. That's a massive expansion of their addressable market.
Okay, let's pull this all together. Second level thinking. The consensus view is Sony is a solid, slow-growing giant, but it's too complex. How does the smart investor see it differently?
The second level thinker ignores that superficial view and focuses on the recurring royalty nature of the hidden assets. The consensus sees the sensor business, INSS, as just another cyclical chip business.
But the reality is much more durable.
The reality is that it's a B2B monopoly that grants Sony a perpetual technological royalty on every premium device in the world. It's high-quality, secular growth hidden inside a manufacturing segment. The market just hasn't correctly priced that asset yet.
So it changes the whole character of the company.
Yeah.
But to be objective, we have to do the red team challenge. What's the counter thesis that could lead to a Kodak warning?
Right. Kodak had the best technology for film photography, but they missed the shift to digital. So what's the equivalent for Sony?
Well, investing in Sony is a bet that dedicated hardware still matters.
It is fundamentally a bet that hardware still matters in 5 to 10 years. The red team argument is that if the shift to cloud and AI accelerates dramatically, the very foundations of Sony's lead local processing on the console and specialized hardware in the sensor could become redundant.
How would that happen?
Computational photography and cloud latency. If AI gets good enough to fix image quality flaws from a cheaper sensor in real time via the cloud, or if game streaming becomes truly instantaneous, the need to buy a specialized, expensive PlayStation or an alpha camera just diminishes. The stream becomes everything, and the box becomes a liability.
So if Sony clings to the idea of selling the proprietary box while the world moves to the stream, they could face this slow obsolescence.
That is the ultimate strategic challenge for them. Sony built its dominance on controlling the format, controlling the platform, controlling the manufacturing. Can that corporate DNA, which is optimized for control, successfully pivot to an open, device-agnostic, cloud-first world? It requires a completely different mindset.
That is a phenomenal synthesis. So Sony has made this incredible transition to a durable IP owner with this hidden sensor monopoly. The thesis is strong, the management is disciplined, but the listener's focus has to be on how they navigate that impending shift in gaming delivery, that existential cloud threat.
And that leaves us with our final provocative thought for you to consider. Given Sony's immense success in building the PS5 ecosystem on hardware lock-in, will their inherent corporate attachment to proprietary devices and controlling the platform ultimately become their single biggest weakness in a future that's defined by device-agnostic, AI-enhanced cloud services? It's the ultimate test of whether a company can evolve past the very things that made it dominant in the first place.